Welcome back. It's time now to take a look at the top business stories. UAE and UK seek to further strengthen trade ties. UAE developer files for bankruptcy claim reports. And we find out how the Indian property sector is looking to attract Middle Eastern investors. Asian markets had a mixed run this Wednesday as investors remain concerned about developments across the Korean peninsula, as well as the European debt crisis. The GCC markets also mended mixed today, and there were similar results across the UAE bourses. The DFM dropped over 1% to close at 1,673 points. The real estate sector continues to fall. MR Properties was down 2%, while Arab Tech lost over 1%. Emirates NBD fell for the second consecutive day. The bank's shares were down 1.25%. DO also fell 0.5%, while DP World gained 0.25%. 85 million shares were traded, valued at 140 million dirhams. The ADX gained marginally for the second consecutive day to close at 2,755 points. Etisalat continued to gain. The company's shares were up 0.5%. Abu Dhabi Commercial Bank dropped over 2%. Aldar Properties fell 1.5%, while Suru Real Estate was down 1.25%. 79 million shares were traded, valued at 142 million dirhams. In a move that could add to realty investor worries, the first UAE developer has reportedly filed for bankruptcy. The Financial Times reports that Al Merjan Real Estate, the owner of the $3 billion 8,000-home White Bay project in Al Khain, filed for insolvency in the Sharjah courts, where two liquidators have already been appointed. The move is thought to be the first court-mandated bankruptcy of a distressed property project since the financial crisis began. Exports from the UAE to the UK witnessed an increase of 38% to £1 billion in the first 8 months of the year, while imports grew by 9%. Officials at the Britain in the Region event held in Dubai today say the two countries are committed to increasing bilateral trade to £12 billion by 2015 by developing high-level political relations, backed by some major trade deals. The event targeted UK companies looking to establish businesses in the Middle East and North Africa regions.
It was decided that we needed to establish an overarching task force to look at the relationship in the round and to take forward work in various areas in terms of trade, in terms of defence, in terms of education, in terms of energy. And that work is being driven forward at a Foreign Secretary level, and that's where the task force is. So we are working to improve relationships in all those areas, and beneath that there will then be activity in each area. And so, for example, in the trade area, we are hoping to establish a business council, which essentially will be a high-level CEO forum where the very senior British businessman can get together with a very senior Emirati businessman.
Now, the government of Ireland is expected to announce a 4-year austerity plan as a part of its €85 billion bailout package, currently being negotiated with the EU and IMF. Meanwhile, Standard & Poor's has lowered its rating on the country's debt, saying that the island's nation is set to borrow more than expected in order to put more money into banks. Well, to discuss the effects of Ireland's debt crisis, we're now joined by Philippe Dauba-Pantanacce, Senior Economist for the Middle East and North Africa at Standard Chartered Bank. Welcome to the show again, Philippe.
It's nice to be here again.
Now, there are growing concerns that the crisis in Ireland will also spread to other European countries, such as Portugal and Spain. What are your thoughts on that?
Well, first of all, the idea of the bailout that was, I would say, almost quasi-forced on Ireland was in fact to contain potential repercussion on the rest of Europe. Portugal is obviously the next in line for the markets, although the problems of Portugal are much different from Ireland, and in fact they have a much healthier, I would say, banking system as well as housing sector. The problem would be if Spain is next in line. If Spain is next in line, it's a very different problem. Spain has a GDP that is bigger than the three other countries, Greece, Ireland, and Portugal combined. So that would put a huge strain on the European mechanism system. Now, what we think is that Spain shouldn't be a worry for the market, but market can be very irrational sometimes.
So what can we expect as possible repercussions for the Middle East then?
Okay, the repercussion in the region would be obviously indirect. There are no direct transmission mechanism between the affected countries in Europe and here in the region. But certainly markets are now, as you know, interconnected, and there could be a fear spillover, I would say. And in these cases, there can be risk reassessment by global money managers, and in these cases, emerging market like this one can see an outflow of money toward more liquid and more quality type of assets. And here we're obviously thinking about the bond market and the US assets, which always benefit from a rising risk aversion from the global fund managers. So that would be the only indirect consequence that we could see in this part of the world.
Thanks for your time, as always, Philippe.
Thank you very much.
GCC markets closed mixed today. Let's check in on those numbers now, starting off with the UAE general indexes. Coming up now, let's take a look at the major international currencies against the dirham, followed by the price of oil and the precious metals. After the break, we talked to Sunil Jaiswal, the founder of the Indian Property Show, about how the real estate sector in India is looking to attract Middle Eastern investors.